Good morning, everybody. It's Herb Morgan, October 6th, 2025. This is my weekly economic and market commentary. You can follow me intra-week on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. But this commentary is best viewed on the YouTube, where you can see the charts and the graphs. This presentation is prepared and it is meant to be used by us and meant to be used by both investment advisors and individual investors, but you're all expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment tax advice, no recommendations for the purchase or sale of any securities. It's all for informational purchases only. Any views expressed in the presentation are mine, and they may differ from the views of CFIEA's parent affiliates or other portfolio managers at the firm. Well, despite a government shutdown, despite lofty valuations, despite a soft labor market, equities go higher. Up one, S&P up 1%, small cap 1.4. Look at all these great numbers. Year-to-date numbers as we ended the quarter last week, all fantastic. This is what you call a bull market, right? You get some bad news, like a government shutdown, like a soft labor market, high valuations, and if inflationary pressures still persist, and yet we keep hitting these new all-time high in equities. That is a classic bull market, and when it's happening, you enjoy it and you don't want to fight it. Let's get into some of the economic data released last week, and then some that didn't, right? With the government shutdown, there are data metrics that are released by the federal government's agencies. Those are shut down. Let's start, though, with some that we did get. National Association of Realtors, a private entity, puts out their pending home sales index. They say in August, home sales were up 4%. That's much better than expected at 0.4, but they're still basically flat on a year-over-year basis, being up 0.5%. FHFA, the Federal Housing Finance Agency, was able to report their numbers for July, the home price index. They say home prices fell by 0.1%. But they're 2.3% higher than they were a year ago. This was before the shutdown last week. But there are competitive metrics. One most notable is the S&P Case-Shiller. That's a private entity not affected by the government shutdown. S&P Case-Shiller Home Index in July down 7 basis points. Fifth straight monthly decline, but even here still up about 1.8% on a year-over-year basis. If you factor in inflation to S&P Case-Shiller, and FHFA, you got a situation where home prices really, adjusted for inflation, haven't appreciated in a way that's good. We've got an affordability crisis in the country. Move on to Chicago PMI. That comes not a government metric. It fell from 41.5 to 40.6, below expectations. New orders fell considerably. Production rose a little bit, and employment fell considerably. So not great news for the Chicago region, but this is a regional indicator, not necessarily indicative of a federal situation. Conference Board, also a private entity, reported consumer confidence for the month of September. They say it fell to 94.2. That was below expectations. I want to point this out here. This is the COVID-related shutdown, right? This is now. So consumers are not feeling much better, if at all better, than they did during the COVID-related shutdown. They are massively concerned about inflation, overall cost of living, whether it's gasoline, housing, energy, food, rent, shelter, education, clothing. All of these things are still at a level of affordability that's challenging for the vast majority of American consumers. We've been hearing a lot of talk about the labor market softening, and we got the JOLTS, or job openings report, last week from the Bureau of Labor Statistics before the government shutdown. The blue line represents the total unemployed in the country. You can see where that is. And the orange line represents the total number of job openings. So the total number of unemployed has been gradually increasing. The total number of openings has been gradually decreasing, bringing the labor market into essentially equilibrium, which should relieve some of the inflationary pressures. But now the labor market, the jobs market, is much more challenging for people. And so you can see normally Total unemployed for quite some time, exceeds total openings, and there's not a lot of upward pressure. But we had a reverse of that happen for a number of years, and we call that inflation. We got the ADP, that's Automatic Data Processing, employment report for the month of September. They say the overall economy lost 32,000 jobs. They were expected to gain 51. Small and medium-sized firms lost all of that, 60,000. And the August number, which had been at a 54,000 gain, was turned around to a loss of 3,000. So now you've got a lot of negative jobs information, a lot of concern in the market. And so you think, well, great, the Fed can just cut interest rates, which is one of the reasons stocks remain so buoyant when things aren't so hot. But the Fed cutting interest rates at a time when inflation is still well above target is a challenge. So we're literally getting into a period of stagflation, a weak, soft labor market, maybe even some job losses, and inflation above target. So which mandate does the Fed end up serving? The inflation mandate or the full employment mandate? This is the question. We heard from S&P Global. The American Manufacturing PMI was solid at 52, right in line with expectations, so manufacturing expanded. But the friends at the Institute for Supply Management, ISM, they say not so fast. It was better, it was 49.1, but it was still below 50, meaning manufacturing contracted. So those two reports conflict on a similar metric. Moving on to services, much bigger part of the U.S. economy, fell from 54.5 to 54.2. That's still good. It's above 50, and that signals expansion in the services sector. The sister report from ISM got back to 50 or fell to 50 from 52, barely stayed positive. New orders barely stayed positive, and business activity, unfortunately, just barely turned negative. So, okay report there. Automobile sales for the month of September rose a bit to an annualized pace of 16.4 million, still well below the pandemic numbers of around 17 to 18 million, so still quite a ways below that. Construction spending for the month of August we did not get due to the government shutdown, so we don't know what happened there. We'll get those later. We've been through many of these shutdowns before. Weekly initial jobless claims we did not get, same reason, government shutdown. Factory orders, that comes out of the Census Bureau, so government shutdown. And the BLS, Bureau of Labor Statistics jobs report, which as you can see had been weak for really the last 4 months, some areas of concern there. No report there on Friday, also because of the government shutdown. Economic data this week, we've got the trade deficit scheduled tomorrow, Tuesday, looking for about 61 billion. Consumer credit expected to be up 15 billion. Minutes from the last Federal Reserve FOMC meeting will be available on Wednesday. And don't forget, we've got an October 29th Fed meeting. Weekly claims for unemployment, which we probably will not get, but the estimate is for 233. And then consumer sentiment on Friday. It's really a light data week, so I don't expect a lot to happen. Maybe there's some trading around government shutdown or around trade deals, the like. The following week, though, we begin earnings season in earnest. We will start with the financials, as you know. That'll be, we might even get a couple later this week, and then really get going the next 2 or 3 weeks. We will get into earnings. Thanks, everybody, for tuning in. I'll be back to you again in 1 week.